All right, let's dive into one of the most powerful and frankly weirdest investment ideas ever. It's a story about how some people got seriously rich, not by chasing glamour and hype, but by digging through what pretty much everyone else considered, well, trash.
So let me just start with this question. What if the secret to building a massive fortune wasn't about finding the next big thing at all? What if it was actually about picking up trash? I'm not talking about startups or flashy tech stocks. I'm talking about forgotten, beaten down junk.
Because, yeah, that's literally what we're talking about today. This is the story of something called the cigarette butt strategy. And believe me, the name, it's just as memorable as the lessons it's going to teach us. Okay, so to really get this, we've got to go back, way back, to a time when one legendary investor looked around and saw a gold mine where everybody else, they just saw garbage.
Picture this, it's the 1930s. The Great Depression is in full swing. The stock market's just crashed, businesses are failing left and right, and fear, it's everywhere. But there's this one guy, a young investor named Benjamin Graham, and he is not running for the hills. No, he's actually leaning in, looking closer, because he sees a massive opportunity right in the middle of all that chaos. And here's how he explained it. It's brilliant. He saw people tossing away old cigar butts on the street. You know, they're pretty much used up, nearly finished. But what if you found one that had just one good puff left in it? It's not glamorous, for sure. But hey, that last puff, it's free. And that simple idea, that became everything. So here's the bottom line. The cigarette butt strategy is all about buying a company that's so ridiculously cheap, so beaten down, that it's almost impossible to lose money on it. The business itself might be kind of terrible, its future, who knows? But you're buying it for less than the value of its parts. So even if the company goes under and has to sell everything off, you still make a profit. You're not marrying the company. You're just there for that one last free puff.
Okay, that sounds good in theory, right? But how does the math actually work? Let's break down the numbers, because this is where it gets really interesting.
All right, check this out. Let's say there's a company, and its actual stuff, its buildings, cash, all that, is worth $100 million. But everyone's panicking, the headlines are awful, so its price on the stock market crashes all the way down to just $40 million. You swoop in and buy it right there. Now, even if the whole thing goes belly up and they have to sell everything off, liquidate, they still get, say, $70 million. You paid $40, you get back $70. That is a $30 million profit on a company that failed. That's the magic right there.
And this is where the story gets even better, because Graham had this student, maybe you've heard of him. He took this exact strategy and used it to start building his own legendary empire. But then, he changed the game completely.
Yep, we're talking about a young Warren Buffett. Early in his career, he was all in on Graham's idea. He was basically a professional bargain hunter, scooping up these cigarette butts. Think dying textile companies, failing manufacturers, the stuff absolutely nobody wanted. He wasn't chasing the next big thing. He was just looking for that one free puff. And you know what? It worked. Big time. He made a ton of money.
But then, something shifted for Buffett. He had this major realization, one that honestly changed investing forever. He came out with his killer quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And that one sentence, that's the pivot. So let's unpack that, because it's huge. Graham's whole deal was finding a so-so company for a fantastic rock-bottom price. That's your one puff. But Buffett, he flipped it. He started looking for fantastic companies, real gems, for just that fair price. He figured out that, yeah, one free puff is nice, but owning a great business for decades, that's a lifetime of growth. So why did Buffett move on? Well, it points to the hardest part of this whole thing. The math is easy, right? But the psychology? Oh man, that's where it gets tough. Doing this means you're in for a serious emotional fight. I mean, really think about it. You have to buy what everyone else hates. Your friends are selling, the news is screaming, get out, and you're supposed to buy? It goes against every instinct in our bodies. It's lonely. Your friends might think you're crazy. And let's be honest, having that garbage stock in your portfolio, it can feel pretty embarrassing. At the end of the day, most of us, we want the exciting story. We want to be part of the crowd. It feels safe. But this strategy, it's the exact opposite. It forces you to shut out all the noise, ignore the story, and just look at the cold, hard numbers. It's a pure battle, logic versus emotion.
Okay, so maybe you're not going to rush out and buy a failing textile mill tomorrow. I get it. But just understanding this way of thinking, it gives you some incredibly powerful tools no matter how you invest.
It really boils down to 4 timeless lessons.
Number 1, price matters. A lot, way more than popularity. 2, when everyone else is scared, that's your cue to get interested. Fear creates opportunity. 3, markets are moody. They get way too excited and way too depressed. And 4, sometimes a company doesn't need to be amazing, it just needs to survive. And if you bought it cheap enough, survival equals profit.
So what's the big takeaway for your own finances? First, you don't need to find the perfect company to make a good investment. What you absolutely do need is a margin of safety. That's the cushion between what you pay and what it's really worth. You also need patience, a whole lot of it. And finally, you've got to have the guts to look where no one else is looking.
Look, in the end, it doesn't even matter if you ever use this strategy. Just knowing it, understanding the logic, that's like a superpower for an investor. It helps you tune out the hype, stay cool when everyone else is freaking out, and really focus on what matters: price and value.
So I'll leave you with this to chew on. In a world that's all about hype and FOMO, the fear of missing out, where's the real value hiding? What's the thing that everyone's bored with, or scared of, or has just tossed aside? Because a lot of the time, that's exactly where you'll find your next free puff.